Good evening, everyone, and welcome to the NGEN Markets training session. So, meanwhile, others are joining in, we will just talk about the topic for today. So, the topic for today is, how to generate model portfolio strategies in NGEN Markets terminal, and then compare it with the client's portfolio for the client acquisition. And you can make multiple sets of model portfolio strategies with certain sets of variables and assumptions accordingly, and we will show you how you can do that with our terminal. So let's head to our terminal and check how we can actually achieve that. Just a second. So I hope I'm audible to everyone, and my screen is visible to everyone. If not, please let me know on the chat box, if it is visible or not. Then I will hopefully take it forward. So here, you can see, as per we are here in the terminal, how to generate a model portfolios. So before generating any model portfolio, creating any model portfolio, we would definitely want to screen certain sets of funds, right? So let's say we clear this all, and we have a criteria altogether in front of us. Just a second. You will see something like this. Once you open the screener, and once you open the screener, you will see lots of mutual funds with lots of categories, with within lots of AMCs in the SEBI classification. So how would we select like 5 to 10 mutual funds, make a model portfolio out of it, name it as a conservative, moderate, or a risky portfolio, and then take it forward and then analyze it. So from here, the process starts from here directly. What you can do is you can essentially screen one set of category or multiple categories in one place. So I'm just going to demonstrate some of the use cases here. One is here that I'm just going to select all the equities, and maybe I can remove some of the sectoral in front of you. So we are just considering these core equities here. You can also consider hybrids if you want. It all depends on your variable. Then once you're done with this, you can also filter the AMCs. If you don't, then you can just directly apply the filters. So applying the filters is a variable concept. What you can do is you can have your own criteria as minimum AUM as 1500 crores, minimum age as 5 years. So these are all variables and assumptions from my side. You can make your own assumptions, a Sharpe's ratio of 0.50, right? And then historical VAR. So these two parameters can also be used, and historical VAR just conveys that there is a 5% chance to have certain risk. When we take a look towards historical VAR of any funds, right? When you scroll just right here, right, you will definitely see a VAR. Just to see, you can see the risk columns essentially, and here you can see the historical VAR. So whenever you want to look towards risk columns, all you have to do is just click on this, preset columns, click on the risk column, and you can easily see the historical VAR. So historical value at risk shows you that there is a 5% chance, then you can have a risk of negative 27 for HDFC mid cap, negative 23 for Axis long-term equity, and the list goes on and on, right? Now you want to select funds which are having, you want to have a portfolio which is a bit of a conservative side. So what you can do is you can easily, take a historical VAR as negative 26 or 27 and then apply it. Now, this is all on the basis of what kind of VAR would you like to have. There is a VAR of negative 35 as well, right? So once you apply these, you will see these are the only funds which fits your entire set of criteria which I've shown you. And I've not even considered the return yet. I've considered the risk adjusted return. I've considered the risk, which is a downside risk, as historical VAR. And these are the funds that fits my criteria. If I say I want to go towards a moderately, risky portfolio, I can just go for negative 30, right? And I apply this. And now I will have certain sets of funds which fits the criteria of my, moderate risk, right? So that is how you can choose certain sets of funds. So I'm just going to take it as 27, 26 on an average. I apply this, and then I'm going to select all these funds and add them to the compare. So let me just remove this all first. So once you see these funds, you can just click on them, add them to compare. You can what you can do is you can also sort them accordingly. Once you sort them, you can sort the best Sharpe ratio funds or a Sortino ratio funds and add them to the compare, so that you know that the funds you have selected are having a better Sharpe ratios. So that is how you can choose any set of funds if required. So let's say I'm considering negative 27 here as well. I apply this, I can add more funds. So these ones, these are all added into the system. So as I've added, most of them into the system, what you can do is once it is added, you can go to the compare section. Now you can see these are the funds which has been, selected by you with certain sets of criterias, and then you can name it as a list. So like, let's say I'm naming it as a, list of moderate, right? So this is my moderate list, and I can just come by whenever I want to know in the equities. These are my moderate list altogether. I can save it. And as per needed, I've actually created multiple sets of list. You can see there are moderate, conservative, risky. There are some strategic list, some debt list as well. So you can create effectively any list so that you don't have to waste your time again and again in the filtration and in the screening option, as you can do one screening, and then you can start with the compare section and then select those funds which are necessary for the model portfolio. Now the one important thing is that even if we select a category, entire category, you can filter, you can just sort it by category. You can easily know that you're holding too many small caps, too many LSS, so you can remove them one by one accordingly, which fits your criteria. Now first thing I would like to check whenever I create a model portfolio is the diversification. So diversification takes place when you actually take a look towards positional overlap and correlations. So position overlap, if I directly head into this position overlap, I can easily see some of the funds are highly positioned, overlapped between each other. Some of the securities in the funds. So you can see Mirai Asset Emerging Blue Chip versus Mirai Tax Saver. Then I have another one with Mirai Asset versus Canara Tax Saver. So you can also see another one with Canara and Mirai Tax Saver. So you can see lots of them are, a couple of them are having a high overlap, even including this Mirai Asset versus IDFC Tax ELSS fund. So effectively, you can select one of them. Now, selection criteria of selecting one of them can be on the basis of your assumption that would you like to go for a riskier fund with more returns or a lesser riskier fund with lesser returns at, right? So you can select effectively by certain sets of parameters. One better parameter you can choose is you can directly go towards rolling analysis, right? And you can run a simple statistic on a basis of simple returns and check on the basis of positive percentage or average return. So I will just give you a gist of rolling analysis here. Rolling analysis just basically means that if I simulate my 260 days return every single day, what would be the average return of this all data sets which I achieve. So for an example, if I invest every day, like any day I choose, like for this day, 30th April 2018, which shows me that if I would have invested, 260 days prior to that, the sum of the 260 days would be 33.46% of SBI small cap. So that is how this works out. Every data point actually denotes that. Now, I would like to know what is my positive frequency. What is my frequency of these all simulation to come into positive? So you can easily see the percentage, and you can see these are the funds which are having a better positive percentage. So on the basis of risk, I've definitely taken a look towards that Mirai Tax Saver is actually a better fund on this contrarian positive percentage scenario. So you can actually remove one of them because either way they both are positionally highly overlapped. So you can just go into the main list and you can just remove one of them. So that is how this works out. You can actually do a proper set of diversification just by taking a look into it. You can see this position overlap. You can see it has been reduced. You can also take a call on Canada or Mirai Asset Tax Saver. Again, take a look into the rolling analysis. So I'm just giving one idea here. The idea can be unlimited because you can actually take a call on minimum vol. You can take a call on average return as well, that if you want funds with better average returns on the basis of rolling analysis, you can easily choose that. So that is how this works out. So in this case, I would remove Canara against Mirai Tax Saver and I will just remove it. So this is just a demonstration of how you can make a selection and remove some of them if they are highly positionally overlapped, right? So once you are done with this, you can also check the risk and return for all the securities which are given here. So checking the risk and return, all you have to do is just click on this risk versus return tab, and you can see how many of the securities are conservative and how many of the securities you've added. Yes, sir.
Excuse me, sir.
Yes.
Can you go back to the rolling? I have some small query.
Sure, sir, we will.
Can we take the questions at the end of the session, please?
Yeah, no issues. No issues.
Yeah, thank you.
So coming to this topic, what I was talking about is that all these, all these simulations we have done, all the screenings we have done, we would definitely want to check the risk and return based on the, selections we have done. So you can easily change the start date and end date if you want. You can simulate it altogether to see if your securities, if you do not want risky asset in your model portfolio, you can easily remove that. So you can see quant small cap is one which is highly risky against others. So I can just, go to the main list and remove it. So that is one case, you can do and make a proper set of allocations to each of the, each of these securities. Once you're done with this, you can make and convert it to the portfolio. Now, converting it to the portfolio is very easy in NGEN. What you have to do is, once your securities are selected, you can just convert it to the portfolio just by clicking on this. So if I click on this, right, it gets saved as a compare 58 because it has been added from the compare section. You can just click OK and you can just head over to the compare section. So if you head over to the compare section, head over to the portfolio section, you can see here, when I collapse this all, you can see from compare. This is the folder which will be generated automatically in your system. And you will see this compare 58. So this is one model portfolio we have created live in front of you. So I will just save it as a model portfolio. Model portfolio live, right? And then we can just save it and add it in our system. So I will also talk about how do you manage the folders. Before talking about that, we will take a look towards, this model portfolio and we will run this. Once we run this, it will be equally allocated. You will see certain sets of allocations. You will see the, asset allocation, concentration, AMC exposures, all these stuffs, but we will definitely want to check the performance of it. So this is what the performance of the funds we have chosen with equal allocation, which we can change later down the line. So these are all the, return set performance stats, which is given as per the allocation of the portfolio. So this portfolio analytics actually denotes that based on the current holding you hold, these 9 items, this is the historical backtest of these, asset allocation of this particular portfolio. And you can compare it with the benchmark. The benchmark is currently Nifty TRI. You can just keep it as Nifty TRI and compare it against the asset. So you can see the, asset versus the benchmark. We have a considerable alpha against the benchmark, and our volatility is considerably lower than the benchmark. So had you gone for a benchmark like Nifty, you would have had better chances of creating, generating better return set with these set of, funds if you make such a portfolio. So this is how this works out. You can make certain sets of model portfolio. We can call it as a model portfolio as a moderate one. I would like to save it as new and make it as a moderate live portfolio, right? So this portfolio will be generated. I can update it, and once it is updated, you can see moderately live portfolio is live. So that's how this works out for creating any set of portfolio. And once I'm done with this equal allocation, I can do two things. One is that I can either keep it equally allocated. I can make my own permutation combination and give the allocation of 30% to one of the fund, which is one another case. And you can use a very good, tool which we have is a portfolio improve, because portfolio improve will give you certain sets of idea as to where to allocate. Let's say I'm just going for a moderate set of a portfolio with a better set of, Sharps ratio. I want my portfolio to have better Sharp ratio. What I can do is I can click on this button, right? And I can, the simulation will generate 6 sets of models. So these 6 sets of models include ranking returns, minimum vol, rank Sharp, and then value models as well, which also includes 3 subsets, right? Now you can easily see that the original, which is equally allocated, is having lesser sets of return against the, against the model ranking models we have. So what we do is, in the ranking model, the allocations are changed. It shows you that if you allocate in such a way on the basis of the return ranks, you would get a better annual set of return from the last 2015 till 2022. right? And you can see the volatility is actually similar. Actually, it is lesser than the original one, and the Sharpe's ratio has increased altogether. So you can go ahead with any sets of models. So the difference is, I'm just going to give you a gist of this, entire portfolio improve. That what you can do is you can use one of the model and then make your own allocations accordingly, or I can either you can choose it as per the model suggest you, right? So let's say I'm going for a rank Sharpe. So if I go for a rank Sharpe, I can easily see that it is one of the highest Sharpe ratio creating model. I can save it as a model portfolio, right? And I'll just keep it as optimized. So this moderate portfolio which I've created is actually been added into the system. And you can see here this model portfolio which I've created. You just click on collapse all. And here you can see the from improve. So from improve, if you see the model portfolio live optimized, this is the one which has been optimized by us.
चेक
So
चेक
now,
करो यार,
now
अर्जन
the
मत करो, फिर शाम तक करके ले लो मेरे को। इतना करके उतना करो।
So now if you can see, this live optimized model portfolio which we have created, you can check the performance altogether. So that is how this works out. You can keep it, as per the optimization has given you the optimization. You can change the allocation as well. This is all your call. This is all the variables we have given you. So the tools, what you have to do is, let's say you are not, you don't want to concentrate highly into SBI small cap, and that is a case altogether, then you can even change this allocation accordingly. You can make it 20 if you want, and you can just increase the allocations in other security which is creating a better Sharpe ratios. So I'm just giving in a feedback here that you can easily do that just by adding it into the system, right? Once I've added, I can rescale this to 100, and then I can run this portfolio. So now I am running this portfolio based on the allocation, and I can check the performance accordingly. So these are the performance. So this performance, which I am narrating it again, this is the historical backtest of the current holdings, what the client holds or what the model portfolio holds. So these are the allocations, and this is the historical backtest of, and against the benchmark, you easily see the outperformance and the annual volatility, right? Even on a risk perspective, as we remembered, we have taken funds which are having a lesser value at risk, right? Which are having a tendency of having risk lesser. So if you create a scenario, you can definitely see the asset which is our portfolio is having a lesser, the probability of us going negative is lesser. So you can see, you can just type it as 99 in a worst case scenario. There is 1% chance that this portfolio which we have created could have a loss of negative 35.62. It is based on the historical returns, and in the benchmark you can see there is a 1% chance we can lose negative 43.14. So there is a huge difference in the risk, but the return side you can see we have created an alpha. So that is how, as a model portfolio, you have created a proper set of model portfolio based on the on the equity side as well. So you can do it on a hybrid side. You can club in couple of ETFs as well if you want to add in into the search, into the screener. All you have to do is just go into the fund section, screen it out properly, take those categories which are needed. It is all based upon your assumption that if you do not want to go for mid cap and multi cap, that is all your call. That is how you can create model portfolios very easily and seamlessly into the system, add them into the compare section, and start analyzing them, checking the position overlap one by one to make a proper set of diversification. And then we also have correlations as well, which can easily see that some of the funds are lowly correlated in equities, some of them are definitely having a high correlation. So like IDFC tax advantage versus Mirai asset, a high correlation is which is closer towards 1. 0.95 is definitely closer towards 1. A lower correlation which is farther away from the 1. Now this is how you can see this is a lower correlation compared to this one. So definitely we are having some assets which are lowly correlating with each other, like SBI versus Parag Parekh. So that is how this works out, and you can even check it even in the portfolio section. This optimized portfolio, this optimized portfolio which we have generated, what you can do is you can just check the correlations directly from here, and you can easily see that we are having a very good set of lower correlations against each other, right? And you can also check, a couple of other stats like contribution, like which of the funds have contributed highly in the model portfolio in the last 10 years to 11 years. Why 10 years? Because we have this, start date here. So you can change the start date, you can keep it as 5 years, and then check the contribution accordingly. So this is a process where you can create, a set of model portfolios. You can name it, as a strategies. We have created couple of strategies to show you around. In the equity strategies, we have created some adventurous, some risky strategies, and even conservative strategies. I will just show you around. And these were all mathematical. There were no biasing. These were the basis of certain sets of ratios and certain sets of parameters taken into consideration, and that's how we have created 15 items, which creates a model portfolio, which can be, shown. You can see the correlations, you can see the contribution and the performance as well. So you can see the performance against the benchmark. It has highly been the benchmark. So accordingly, once you're done with this, now why this entire process? First, this process helps you to select effective funds based on certain sets of parameters like Sharpe's ratio, or even Sortino. Even you can use value at risk. Another is that whenever you have a client portfolio in place, or whenever someone creates a random set of portfolio, you can easily compare that random portfolio. Why am I talking about random portfolio? Let's say you have selected couple of funds based on their performances, or maybe on the point to point performances. I'm just going to remove this all, and I'm just going to add in a random set of, a list. Just a second. Any list would work out. Just here. So this is the random list I'm adding. So now this is the random list I have. Some of them I've chosen on the basis of, thematics. Some of them are chosen on the basis of point to point returns, and then you have added it into the system. Now once you convert this to the portfolio, or once you make it to the portfolio, right, you can compare that random portfolio with your own model portfolio, right? Because your model portfolio was all methodological. With all the methodology, you can actually see the alpha which is generated. So if you want to compare any sets of portfolios, there are two ways to compare portfolios. One is directly from this tab, you can see from here. Another is, if you're in the portfolio section, all you have to click is on this button. Some people are not aware of this, but this is a button which also helps you to onboard into the compare section. All you have to do is just click on it. The compare section, gets activated. Now let's say this is one set of a model portfolio I'm just adding. Let's say compare, right, 58, which is one we have added as a random portfolio, and another one will be a model life, right? So this is one we actually optimized, right? So we can also optimize this one, but you can easily see the, generation of the alpha, which is alpha in the sense we have generated better returns against this, portfolio, which is our own model portfolio. So I can change the, portfolio with any client. I will just type in a client here, client prospect here in front of you. And then you can easily see that model portfolio, which we have created in life sense, has actually beaten this portfolio. And not just one for one point of the time. What you can do is you can change the current start date. So the start date here, as you can see, is 30th December 2023. You can change it accordingly. You can keep it as per needed. Once you click on go, based on that particular start date, 1st September 2014, you can see the annual return over the benchmark. So annual return over the benchmark, which is positive 5.40, is actually this model portfolio has been giving better returns against this client prospect. How you can check that? You can easily check that from here. This is the compare section, which is very, very fast. This gives you an idea that on the basis of this particular set of custom start date, annual return of this particular set of portfolio is 12.70, whereas the model portfolio which we have generated is 18.14. And the annual volatility. Now, this is a very, very interesting case, that the volatility of our portfolio is actually lesser than the volatility of the client prospect. Now, why is the case? Because we have tried to take conservative funds, not in the basis of the name, but on the basis of their behavior in our portfolio, right? So you can see the Sharpe ratio difference. We are having a better risk adjusted return. You can easily see the difference here. You can see even in the performance stats, in the up months and the down months, we are having lesser down months, whereas this particular portfolio is having higher down months. So this portfolio was actually more negative. And if you check the drawdowns, it's another interesting case, because you can see here in 2018, if someone would have had this portfolio, right, he would have sustained a loss till 2020 for 2 years. And that actually shows the case. He would have had a loss from 2018 to 2020, and the recovery would have been 110 days. That's okay. But here you can see the same period we also had a loss, but our loss period actually sustained till 2018 only. In a period we started recovering and we recovered. Then we had another set of loss which we recovered again. So this portfolio had a better strength on basis of loss, and also on the basis of recovery. And that's you can actually check it out. Every gray area you see is a loss period. It's a drawdown period. If I just zoom this in, right, this is a drawdown period which started from here and ended here. Even for if I zoom this in, I can easily see the drawdown period which started from here and ended here, and then the recovery started. So you can see the recovery which has started. So that's how you can compare two drawdowns of two portfolios. I can add in a conservative portfolio here, right? Any conservative will work out, and then I can just check it out myself. So if I'm having, you can easily see that even in this scenario, I had a very lesser drawdowns. And that's another case you can take a look towards for any particular set of portfolio. Even a moderate or a risky portfolio, I will just add in a risky portfolio. So this is a benefit of having multiple sets of model portfolio. You can compare it with the client. Because I've added 4 or 5 model portfolios, I can easily just type in the model portfolio like risky, optimized, any one of them, and compare it side by side to see if it is making sense or not against the client. I can see the performance, which is performance contribution. I can see how it has beaten the client prospect. I can check the asset allocation, which is another case you can check. If you want to see the diversification based on the holdings, you can see the market capitalization how it is allocated altogether. You can also check the exposure on an exposure level. So you can see it is highly towards a thematic category like Sun Pharma, Dr. Reddy's, and Fortis Health, whereas we are having different sets of allocations like in banking. So you can check that as well, and you can check the capitalization. So this is highly towards mid cap, right, as an entire portfolio, but this is highly towards large cap. And then you can check the rolling returns. This is another use case which shows you that on the basis of 1 year, we are having an average of 15.56 or 46, whereas in 1 year this is having an average rolling return as 12.39, and the rolling volatility analysis as well. So essentially this is more volatile as a portfolio, whereas this particular set of portfolio, and then the drawdowns. So once you're done with this, you can create a PDF out of it. This will be useful for you. If you feel this model for portfolio works out, you can just type in the capital which should be deployed, uh, click, and a proper comparative PDF which can be used for a client acquisition, or conveying the client that why this particular set of portfolio is actually superior than the original. So we have also given this particular set of PDF. You can just scroll it in. All these details are already given in the analytics. And what I've chosen is that on the basis of capital, this is what the capital should be deployed. If I if I remove my position from this particular set of portfolio, that is how I need to allocate to have a moderately high risk portfolio of yours. So considering this, you can actually convey this proper sets of ideas if you want to convey a model portfolio. Another thing is that if you have many model portfolios, you would definitely want to simulate all those portfolios and compare them. You can compare two model portfolios in one place. You can just write in conservative here. So for comparing, all you have to do is come into the compare section. I'll just type in a conservative here, right? This is the conservative portfolio I have, and I'll just type in another moderate. Okay, not this one, just a second. Okay, so this is the conservative portfolio I have, right? And I can just go ahead with a risky portfolio. So in a risky portfolio, right, I can just type in maybe more highly adventurous. So I will just type it. right? So in this highly adventurous, I have another portfolio in front of me. Now, this is another case. Okay, just a second. Let's type in another one. EQ highly adventurous. Okay, this is the one which we have optimized anyways. But if you see this, you can definitely see the performance, right? Now, the thing is that you can check the volatility has increased and also the return set has increased. But if you want to simulate it for multiple portfolio, how would you do that? We have it in our system. We are not, I've seen it. Many people are not using it, which is through custom securities, because you can make these model portfolios as a custom securities. You can run multiple set of comparative analysis in one single place. Let's say you have a use case. I want to know the calendar year returns of these two portfolios. Let's say what has happened to these two portfolios in 2020 or in 2018 or in the times of crisis like COVID 2020 or maybe 2016 of demonetization. I would like to simulate that. I would like to see that. How would I do that? All you need to do is, whenever you're in a portfolio section, right? uh, Whenever you have this, any portfolio, make it as a custom security and simulate it. All you need to do that is one step is to make it as a price series. We have given an button here that this price series gets downloaded in an Excel format. You copy this price series into the custom securities tab and paste it. That's it. Once you are done with that, you name it properly. I'm just going to show you the entire process here. This is, I hope my Excel is visible to everyone. If not, please let me know. I'm just going to check it. Okay. I hope it is visible. So if you see this, right, the entire date and price, you can just copy this and just paste it into the system, my securities. I'll just type it as a moderate portfolio, right? I keep it as equity. I copy this, I validate the input, and this is what my price series is, and save it. Now I'm done. So you can easily see I have done this many times in the debt and even in the equity side, that many portfolios has been saved. Like many equity portfolios, many conservative portfolios I've made here, which we have made as a product team, to show you that if you can compare as a custom securities, you can easily do every single analysis you are doing for a mutual fund or even for a stock. Like if I remove this all, because this compare section is very robust, I can compare multiple sets of model portfolio strategies in one place. You can see this, all three strategies which I'm adding, which is equity, MF moderate, equity MF conservative, and equity, okay, not this one. Okay, just the last one is highly adventurous. Now these are the three sets of model portfolios I've taken into consideration. Just a second. Okay. So these are the three model portfolios I've taken into consideration, and you can easily check the CAGR based on any particular set of date. You can just take a date accordingly and check the CAGR of each fund. So you can see moderate has been a better option in this from this start date, right? Because it is a point to point, sometimes you will see that your moderate portfolio is outperforming a highly adventurous or a highly risky portfolio, and that might, right, because the timing is so important in certain cases in CAGR. So even in this case, you can easily calculate based on the Nifty, which portfolios have beaten the Nifty. Now, this is another case, which portfolio is having a better, higher correlation or lower correlation. Any particular benchmark you can choose. And this is one use case I'm showing you through the main list only. There are multiple sets of use cases. All these, buttons which are given here, that also apply for model portfolio strategies. And that is where you can actually create another sense of, analysis on a portfolio level, not just on a mutual fund level. Let's say I want to run a risk versus return analysis. I can easily do that. I can check any particular set of date. I can click go. I can easily see that, in this particular point of the time, my moderate portfolio would have been a better option, and highly adventurous would have not given me that much set of a return, annualized return. And this is the conservative portfolio. Whereas you can also save a prospective client's portfolio as a security. Like how I shown a model portfolio which is saved into the system, I'll just show you the prospective client here. You just add into the system and you can just check the prospective client underlies here. Change the dates. After changing the dates, you can actually analyze it in a live sense that on the basis of this is where the prospective client is. These are all your model portfolios, right? Even on the basis of correlations, you can see correlated are your portfolios, not just mutual funds, not just stocks. And you can also check what is your calendar year performance. We were talking about the calendar years, that what would have happened in 2016. You can easily see that on the cases of simulation, prospective client was the loser in 2016 on an annual basis. So you can see this, on a calendar years, you can see all sets of analysis here. You can actually simulate that from 2010. So this is all through 2010 because all of them are having a start date of 2010. So this is how you can do that. And another thing is rolling analysis, which is another use case. You can check that the simulations we have made, from the start date of 2009 till 2022. So let's say I'm taking a consideration of 2012, right? And if I run this for a 1 year period, I want to know which particular portfolio has given me the best average, which is equity moderate portfolio, which is 3.2. Now, the use cases are huge because now you can add in debt strategies. Now you can add in another set of strategies. How many strategies you want to add, you can add. Even some customized index. I think we had a session before on customized index, which is this one. This one, the customized index, which included Nifty, NASDAQ, and Nifty, NASDAQ hybrid, right? Now you can compare it in a yearly format, right? So this is another good use case. You can actually check on a sense that, if I would have taken this hybrid index, this is where the hybrid index stands in 2022. And once you are done with this, you create a PowerPoint report. Now, PowerPoint report will not include positional overlap because this is a custom security anyway, but it will also include, some sets of parameters which will be very, very useful if you want to display all those strategies in front of the client and then, present it up. Either one of them can be chosen. So this is another use case. I'm just going to show this PowerPoint once it loads up. Just a second. Yeah, I hope it is visible. Yeah, so I hope it is visible to everyone. This is the comparison report, which shows you the security comparison. So every single comparison is given here. So, all the strategies are given here. You can check multiple sets of performances. You can check the 1 month till 5 years, 7 years as well, if you have the start date on that particular point of the time. And you can check the calendar years and even the rolling analysis. So rolling analysis is also given here. You can just use it accordingly, customize it accordingly for your client. This is all co-branded anyway. This will be very, very useful, which will be, as a report. You can save it as a PDF and then, use it as a proper set of a report. So this is all about the model portfolios and the model portfolio strategies. We are definitely going to be coming up with certain sets of automated mathematical based strategies in our system coming soon. But you can also simulate that. You can also do that directly from the screener and start doing them. If you want riskier portfolios, keep a value at risk higher, make use of volatility more, and you will definitely get those riskier funds in those brackets which you want to create as a model portfolio. So that is all for the session. We can start with the Q&A. I suppose we already had a query on rolling analysis. So if you can start with that, we would definitely answer them. So are there any questions?
Yeah, I would like to ask one thing. With regard to value at risk, here you said minus 26%, minus 27. What will be good for conservative or moderate and risky?
Yeah, hi, this is Aruna.
Hello.
There is no, hello, yeah. So I'm saying that there is no real kind of number that is better or worse. It is more something that is relative to one another. So this basically, there's no such cutoff that, below 25 or about 25 is good. This is just to give people an idea of risk. So, when you see a minus 27 for a 95% bar, as you know, it just shows you that, there's a 5% chance that you can lose 27%.
On a
it's
single
out,
day?
yeah.
On a
No,
single
annual basis.
Okay.
Annual basis. So this basically tells the client that this is the outside case. It will most likely not happen because there's only a 5% chance. Means 5 times out of 100. They can be very unlucky. If they're very unlucky, even then they'll be down 27% annually. That is what is showing. If you want to see an even more unlucky case, you can make it, 99, and you'll get an even worse number. So it is not to say that this loss is likely or even 50% likely. It's 5% likely. But again, it's just to make sure that the client understands that the possibility of losing this much money is there. And then the most useful part about this is you can see the 95% VAR of one portfolio, as Umair was showing, and compare it to the 95% VAR on another portfolio. So if you've created a better portfolio on NGEN Markets, for example, you can put the client portfolio on one side, say that, look, the 95% VAR is 30% on your current portfolio. What I'm giving you, the 95% VAR is only 25. So even in the unlucky case, I am going to lose you less money.
Correct.
So that in that sense, it can be quite useful. And VAR is a concept, at least from its definition, is reasonably easy to explain to a client. You can just say that, this is mathematically speaking, this is your if you have a bad year, right? This is what it could look like, basically. And it doesn't mean that a bad year is going to come. It means that it may come.
Correct. We can say it is 2 standard. 95% is 2 times standard deviation.
Yes. So this will be 2.43. I think the exact number is 2.4 or something like that.
Yeah, 95.14.
Yeah.
Okay, thank you.
Perfect.
Hello.
Yes, sir.
Sir, this is Deepak, sir. Sir, I'm not able to rename this thing, sir. Portfolio saved, compare portfolio, change this thing, sir. Name.
Okay, if you want to change the name of any portfolio, on the left side menu, as Umair will show you, there is a rename option.
Yeah, but even doing this thing, it's not changing, sir.
Okay, so Umair, can you just show one simple name, maybe? Just take something that is a bit simple. Here. So as you click on rename, that name will become an input box. And
Yes,
you keep typing the new name. After that, you hit enter once. That's it. Hit enter. Yeah, and that's it. That's how it will change.
Okay, just a second. I'll check here and there.
Yeah.
But I've tried many times, but it is not happening. Just a second.
So if you just click rename, then you type the new name and hit enter once. That's it.
Okay.
Are there any other questions?
Sir, Mangesh here. Hello.
Yes, sir.
Sir, you were explaining about downloading the price series, copying it in portfolio comparison. I was not in a position. I mean, I could not follow it. Can you explain it once again?
Sure. Just to make sure we when you run a portfolio, you can download the price series. That's one part of it. That's pretty straightforward. Once you run the portfolio, you can see where Umair is pointing his mouse. You click that and you get a spreadsheet download. And in that download, you will see date, you will see the portfolio NAV, and another additional column which you don't need for this particular topic, which is just the daily return. So that is the spreadsheet, right?
Okay.
Now, separately from this, we also have another functionality called custom securities, which
Okay.
let's go back and show, which is the last section on the left-hand side.
Okay.
Here,
My
this one.
securities. Yeah.
Yes, my securities. So you click on that, you go to that section. Here, this section is kind of like your own notepad, basically. We don't provide the data. Here, you provide the data, right?
Okay.
So in this, you could have your data from your other sources also, right? You could have a real estate price, whatever you want, you can save it.
Okay.
So in this case, what we are doing is we are taking the price series from the portfolio in Excel,
Okay.
right? And then putting it back into the system as a custom security, like here,
Okay.
right? Date, price are being saved. You call it some name that you can recall, and then you save it, and it'll become it'll become a security that belongs in your login, basically.
Okay.
Forever. And you can even run analytics on it on this platform, on this section right here. So let's just finish this saving. So Umair, before you go to compare, let's just show him that it shows up in the list on the left. So yeah, so there it is. I think let it finish saving. Yeah, now it will come. Okay. So that is this security we just saved. You can click on it and it will run also. It is just the price of the portfolio. Now, the third step is if you go back to the compare section. In the compare section, you can compare everything from funds, stocks, indexes, or even your own securities, which is this drop down.
Okay.
And you find that thing that you saved right now and you load it.
Yeah.
And as far as the compare section is concerned, it's just another return series, right? So it will get loaded in and analyzed alongside whatever else. You can put your portfolio versus individual funds, stocks, whatever you want.
Okay, sir. Perfect. Understood. Thank you.
Thank you. Thank you.
Thank you.
So are there any other questions?
Somebody asked about a recorded version. In case you are not aware, there is a videos link inside the application, always available for you. A recorded version of all our training sessions are actually put there. It's a public site. It's a YouTube channel. You can, if you want, you can subscribe to it, so you'll be notified of updates. But anyhow, you can come here anytime. All the webinar recordings are here. Separately, we have some functionality videos, and very, very soon we are also going to be releasing very short, less than 1 minute videos for small functionality and little features all over NGEN Market. So those should be coming soon as well. So you can visit this YouTube channel anytime to check videos. So for example, the recording of this session will also be put on there soon.
So are there any other questions? You can write us on the chat box, or you can just ask verbally. Any questions?
Okay, if there's nothing else, Umair, I think we can close it for today.
Okay. So thank you so much, everyone, for attending this session. We would definitely come up with few more functionalities, few more topics on webinar as well, to show you around how you can effectively use NGEN Markets, not just to acquire clients, but to do your own research and to be well aware of what kind of you're doing. We will help you in automating your research as much as possible. So thank you so much, everyone. Have a nice weekend ahead. We will catch up again next Friday, same time, 4 o'clock. And we would definitely get back to every one of you. If you have any other queries, please let us know in the next webinar. Please attend the next webinar. And I'm also typing a mail here, support@engineresearch.com, which we are actively managing. So you can, write us your feedback, your queries, all of them in one place, and we would definitely, get in touch with you. So thank you so much, everyone. Have a nice weekend.